Hello, everyone. Welcome to this edition of Let's Talk Investments. I'm Arun Gopalan, the head of research at Centrum Finverse Ltd. And tonight we have with us Mr. Manish Jain, the head of fund management at Centrum PMS. So, Manish, welcome to the show. Our objective on the show will be to unravel this rather complex situation that is emerging in the world of investing. And Manish, with his 2 decades of experience behind him, will help us go through and navigate these turbulent waters. So, Manish, welcome to the show.
Thank you so much. Thank you for having me. The pleasure is entirely mine.
Thank you for coming. So, I'll get straight to the point here and let's talk investments. So, Manish, we're looking at the world around us in a very different way rather than what we did in maybe the last few years and even a few decades because the world order seems to be changing. And in this rather complicated conundrum of macroeconomic and rather geopolitical turbulence, uh, how do you see India positioned? Are we vulnerable? Are we facing a lot of headwinds because of this? Or do you think there is some opportunity for the Indian economy in all that's happening and we'll come out stronger on the other side? How do you read this?
So, we are at a very interesting juncture at this moment as far as the whole macroeconomic situation is concerned in the context of the global geopolitical situation. Now, global geopolitical turbulence is not something which is unheard of new, especially in the last one odd decade or thereabouts. We saw the COVID, then we saw the Russia-Ukraine war, and there have been a number of events that have happened at very periodical interval, at a very regular interval. And every single time we've kind of come out by and large okay from that situation. We've rather been insulated each and every single time. And that makes you believe that the inherent strength of the economy, which is largely domestic driven, has not really been impacted by the global pushes and pulls, which is also shown FCY24. If you see in terms of the FII selling and the impact of that on the Indian markets as well, we were largely again okay over thereabouts. So this is the first time when this whole Middle East crisis seems to have actually had an adverse impact on us for the first time. Why? It's not so much about the conflict in itself, but it's more about the supply chain disruptions that are happening because of it, right? So when you look at natural gas, when you look at oil and gas, and all of these, critical materials that need to come in through at a regular interval, they are getting impacted. So are we going to be insulated this time around? The answer is no. Are we going to get impacted? Yes. How much? We don't know at this juncture. There is obviously going to be an impact that we'll have on current account deficit. If we reach 2% odd levels negative, I will not be massively surprised over there. There is going to be an impact on inflation because of gold and then oil and the currency when you put in the mix of that. And that essentially means that the RBI's behavior will also change. You have to factor in a little bit of a rate hike in this current calendar year from that perspective as well. So there is a large number of factors which are there at play, which are going to impact us. The problem is we don't know how much at this juncture.
Absolutely. The uncertainty is there, the Damocles sword over us. But Manish, given all of this, it means that there will be pressure on the current account. We will be seeing RBI maybe, hike rates sometime later in the year if inflation becomes sticky. Let's come to the macroeconomic numbers. India has shown very resilient growth in the past. We've seen 6.5 growth above of 6%. We projected a growth of 6.5%, and we've always looked at the Indian economy being very robust, among the fastest growing economies of the world, and that's how we've planned our investing approach to investing and allocated money largely in India. But do you see any of that growth getting dented because of this in the next 1 year or 2 years? Are projections going to take a hit?
I do believe, putting my neck out over there, but I do think that we are almost there as far as the resolution of the issue is concerned. We are in the last leg or thereabouts. So there is going to be a resolution which is going to come out fairly soon. So no, there is not going to be a 2 year impact on the economy, but is it going to be a 1 year impact on the economy? The answer is absolutely yes, because we saw, the first thing that comes to my mind is that we saw in the last budget that the fiscal situation is very tightly balanced out. We did see a certain amount of revenue shortfall, and with the capex coming back in a certain way, especially in the defense and central government capex, with the spending kind of coming back, the budget was very tightly balanced, and this year also the projections seem very tightly balanced. So there is going to be a little bit of a disruption over there, which is inherently something that you need to factor in. And the second part is that with a 50 basis point kind of a rate hike that you are kind of looking at, or at least I'm looking at in this current calendar year, this credit growth in the economy, which has started coming back, might actually get hampered a little bit, might actually get pulled back a little bit. So these certain factors that you need to, build into your assumption. Is the GDP growth rate going to get derailed by much? No. The answer, are you going to still see a 6% plus sort of a GDP growth rate this year? The answer is absolutely yes. But are we going to be completely unscathed? The answer is no. There is going to be some dent to it.
The question that I had, following through with what you just said regarding the 6.5% GDP growth, which you say above of 6% will be intact. But are we seeing that reflect directly into the corporate numbers? Because I feel there could be a divergence between what we're projecting on the GDP numbers at a broader scale, and when we get down and look at the earnings with the companies are reporting, is there a connect, or do you see any kind of disconnect there between the broader projections and the numbers we saw in Q4 this time?
Yeah, so your point is absolutely valid actually. When you look at, for example, Nifty now, and then you look at Nifty earnings, over there, there definitely seems to be a little bit of a disconnect. When you look at Q4 earnings and the way they came out, we actually did not see any impact of the war on the growth or profitability or margins at all, right? There has been nothing which has happened over there as well. So that is why we've not seen large scale earnings cut actually happen in the way they should have. People are still building in about 1250 sort of a EPS for Nifty from a next financial year perspective. My sense is the more realistic number is between 1200 to 1220. So there is a certain bit of a cut that still needs to happen. So is the earnings reflecting the macroeconomic situation? The answer is no. Q1 and Q2 will see that pressure, especially not just on the growth part of it, but more so on the profitability or the margin part of it, right? So that impact will definitely come through. But the second part is that, is it reflecting in the valuation? I think to a very large extent, yes, it is. If you go back in time and see, then for the last 25 to 27 odd months, the markets point to point have kind of remained flat. Yes, there has been volatility in between where we've seen 21,000 also, and then we've seen 24, 25,000 also. But the fact of the matter is that, valuations are absolutely intact from a point to point perspective. And in that respect, the markets which typically tend to trade at 20, 21 times valuation has seen some bit of a pullback happening. So valuations are reflecting the reality, but the earnings are not. Earnings cut are still going to come through.
Right. So that's a kind of a fence sitting kind of an approach that one has to look at right now. Is that you're not really sure whether the earnings is going to come back in the second half, or first half definitely seems to be impacted because Q4 numbers have not reflected that, obviously, because this came in the lag at the tail end of the quarter. So my next question to you, Manish, is directly picking off from where you left off over here. When you look at the broader earnings season that has just gone by, what are your takeaways from it? How does the profile look in terms of the earnings season? That
I think things by and large look okay right now. When you break it down sector to sector, for example, banks had a great set of numbers across the board, not just banks, but the entire BFSI space. When you look at it, when you look at the credit growth, when you look at the asset quality, when you look at, the PPOP growth across the board, I think banks look very, very good and valuations are very compelling. So that's my takeaway from there. As far as IT is concerned, we're sitting exactly on the opposite end of the spectrum over there, where valuations are great. I mean, you're at a lifetime low, especially in the large cap IT space. But at the same time, there's no visibility on when the growth is going to rebound at all or not. And then there's a sentimental hangover also of the impact eventually AI will have, and what kind of an impact is it going to happen over there or not. But I think the numbers by and large played out sectorally exactly in the way that I thought it would be. Some sectors, some stories look very, very compelling. For example, banks look very good. When you look at transmission and distribution story within the power story, I think that continues to look great. Certain pockets of EMS, I think they're looking absolutely great over there. So these are the areas where I'm going to continue to focus on from a medium term perspective. And this is where either you play growth or value or a mix of both. I think it's a great bottom up strategy.
so, Manish, the question that I have for you is how much do you think this FII selling is actually going to structurally impact the Indian market? Do you see something negative playing out in the weeks, months, and years to come because of the FII pullout? Or do you feel that some point in time these FIIs are going to come back to India for whatever reason? Maybe the valuations start looking more attractive. But do you really see that FIIs as being a major player in the market now, either negative or positive? Or do you think the DIIs have adequately compensated for that withdrawal? So, what's your take on that?
till a certain point of time, yes, DIIs did compensate quite adequately for the FII shortfall. I'm talking about when you look at the calendar years 21, 22, 23, and 24. So in this gap of 4 years, FIIs actually have been sellers since 21 to now, right? This is the fifth year in a row when FIIs have been net sellers in the Indian equity markets. But the issue is that when equity markets continue to remain flat or unresponsive to returns for a very long period of time, and we are looking at a 2+ year data now, then retail investors or HNI investors also tend to become a little despondent, right? And that's when the overall impact of on the market as far as FI flow concerned becomes even more accentuated, and that's something which is very visible when you look at, for example, calendar year 25 and so far 26. You look at the number of companies that have come out with IPO and the price they have got listed at, and then what has happened in the subsequent next 1 or 2 months as far as that pricing is concerned and where it has gone. And that really becomes an overbearing impact. So FII need to come back. Are they going to come back anytime soon? The answer looks to be a mixed bag for me. But at the same time, I do believe US valuations are now getting into a zone which is like bubblish and we are a little more attractive. So as and when this embargo lifts, as and when the visibility becomes clearer, I do expect a very sharp pullback to happen in the market and the sentiments to overall improve quite dramatically.
The question that I have for you is Indian valuations. 21 TTM, just about less than 21 year forward.
Yeah.
Are we an expensive market? Are we undervalued or are we overvalued or are we fairly valued? And how do you think investors should look at this market right now? Or whether overseas investors or Indian investors, how do we now, how do we appear positioned when we look at other emerging markets? Are we attractive or are we overvalued?
See, I think the problem is that when people tend to look at valuations of equity markets globally or between emerging markets, I think we tend to ignore two things. One is the profitability of the market, so the ROE that the market kind of generates, and at 15, 16%, I think we are ahead of other geographies by a very wide margin, right? So there's that element that needs to come into the play over here, and that is one of the reasons why you look at the last 20 years of history and you realize even in the toughest of the times, valuations have rarely sustainably gone below 18 times, right? So that typically tends to be the bottom level where it is. And in the peak, they have kind of ventured into the 23, 24 times as well. So when you look at on a standalone basis, 20 times might seem expensive to somebody. But in the context of the ROE that we generate over here and the deleveraging that has happened in the system in the last 6 years, I think we are between undervalued to fairly valued. We are in that zone.
Large, mid, small. What's your take?
I'm more leaning towards mid and small cap at this juncture. I think typically when markets tend to fall, small caps tend to fall first, large caps tend to outperform. But when you're in a rebound mode, which I feel we are going to get into, small caps are going to give you a better delta or better alpha in your portfolio as compared to larger caps. So definitely mid and small cap at this juncture.
Wow. So mid and small caps the way to go. Well, thank you so much, Manish, for your valuable time and those thoughts. And let me just sum it up. What Manish has just said over the last 20-25 minutes that we've been talking to him. This is an opportunity. Don't run away from it. Think long term. Buy stocks that are cheap. Don't go after sectors that don't have visibility. Avoid those and get into sectors where earnings have a runway ahead of them. Build a portfolio with a long term in mind. The turbulence that you see now may be lasting for another 3 months at the most. The supply chain constraint. After that, when that goes off, that pressure goes off, you will find markets in safe waters again. So, investors, think judiciously, invest for the long term. That's Manish's advice for you. And thank you, Manish, for your time. And we will come back to you in our next edition of Let's Talk Investing very soon. Until then, happy investing. Thank you, viewers.